Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PPL Corporation Annual Report. PPL Corporation offers a diverse range of businesses and services to its customers. The company provides electricity and natural gas to approximately 3.6 million customers across the United States. Its operations are divided into three main segments: Kentucky Regulated, Pennsylvania Regulated, and Rhode Island Regulated. In these regions, PPL Corporation engages in various activities such as transmission and distribution of electricity, generation, transmission, distribution and sale of electricity, and distribution and sale of natural gas. The company also sells wholesale electricity in Kentucky and generates electricity from power plants in the same state. Additionally, it produces electricity from a mix of coal, gas, hydro, and solar sources. Overall, PPL Corporation services include electricity generation, transmission, and distribution, as well as natural gas distribution and sale. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a company's stock price to increase. The stock price of PPL Corporation, PPLC, has seen a slight increase over the past year due to several factors. One key reason is the company's strong financial performance. PPLC has consistently reported steady revenue growth, driven by its expanding payroll services and benefits administration business. This stability in earnings has attracted investors who are seeking reliable returns on their investments. Another factor contributing to the stock price increase is the company's strategic acquisitions. PPLC has made several strategic purchases of smaller companies in the human resources sector, expanding its market share and increasing its capabilities. These deals have not only boosted revenue, but also provided opportunities for cost savings and operational efficiencies. Additionally, the company's focus on innovation and technology has helped to drive growth. PPLC has invested heavily in digital platforms and tools that enable employers to manage their workforce more efficiently. This shift towards digital solutions has improved customer satisfaction and retention, leading to increased loyalty and repeat business. Lastly, the overall market conditions have also played a role in the stock price increase. A rising interest rate environment can make stocks with strong earnings growth and dividend yields more attractive to investors. As a result, PPLC's stock price has benefited from this trend, attracting both individual and institutional investors who are seeking stable returns. In conclusion, the combination of PPLC's solid financial performance, strategic acquisitions, focus on innovation, and favorable market conditions have all contributed to its slightly increased stock price over the past year. PPL Corporation maintains a market capitalization of $28 billion, broadly in line with the industry peer group. PPL Corporation trades at a higher price-to-earnings ratio of 25 times and a higher price-to-book ratio of 1.86 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.04%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for PPL Electric, LG&E, and KU can be identified through an analysis of recent developments. On the revenue growth side, proposed rate increases in various jurisdictions, such as Rhode Island, are expected to contribute significantly to additional operating revenues. Additionally, authorized returns on equity and approved budgets for infrastructure projects will also boost revenue. In contrast, several factors have led to a decline in revenue. The denial of new rate adjustment cost recovery mechanisms by LG and E and KU has resulted in lost opportunities for revenue growth. Furthermore, the conditional withdrawal of stipulation for the Kane-run BESS project and refunds of credits previously withheld due to FERC's order have also contributed to revenue decline. Other factors, such as commodity price fluctuations and volumetric risk, are considered neutral or complex, as they can be mitigated through cost recovery mechanisms and other arrangements. Credit risk is another factor that requires careful management, but it is largely mitigated by credit policies and master netting arrangements. Overall, the drivers of revenue growth or decline for these companies are multifaceted and influenced by a range of factors. The net income of the company experienced a significant increase between 2024 and 2025, rising by $293 million. This growth was also reflected in the year-over-year increase of $65 million. Furthermore, the net income saw a notable 12% increase, amounting to $42 million. The recovery of transmission expenses, gross earnings taxes, and net metering credits contributed to an additional $140 million boost in net income. In contrast, the profit margins showed mixed results across different segments. While the Rhode Island regulated segment witnessed an increase in profit margins, the Kentucky and Pennsylvania regulated segments experienced a decline. The decrease in profit margins was also evident in the overall segment net income as a percentage of operating revenues, which dropped from 16.1% to 15.4% in Kentucky regulated and from 17.3% to 19.1% in Pennsylvania regulated. The net income margin, however, presented an interesting trend. It increased significantly from 9% in 2022 to 26.4% in 2025, indicating a substantial improvement in the company's financial performance. Nevertheless, there was a slight decrease from 53.7% in 2024 to 51.6% in 2025, suggesting that the growth may have slowed down slightly. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to multiple sources, the net cash provided by operating activities has been consistently high across all 3 years. In 2025, the company reported an impressive $2,629 million in net cash provided by operating activities on page 94. This figure was further corroborated by other sources, including a net cash provided by operating activities of $1,050 million on page 104 and $599 million on page 110. Additionally, another source reported an operating cash flow, OCF, of $3,117 for the same year on page 143. Furthermore, a net cash provided by operating activities of $798 million was also recorded on page 116. These figures collectively demonstrate that the company is generating significant positive operating cash flow in all 3 years. The debt levels of various entities within the company have undergone significant changes. For PPL Electric, short-term debt increased by $473 in 2025 compared to 2024, while long-term debt maturities decreased by $1.3 billion between 2024 and 2025. In contrast, LG and E and KU saw an increase in their debt levels by $400 million and $500 million, respectively, from 2024 to 2025. The interest expenses for PPL Electric and LG and E have also increased significantly from 2023 to 2025. This is likely due to the exchangeable notes issued by PPL Capital Funding, which may impact future periods' interest expenses. The company's overall debt level has not changed significantly, with some entities experiencing an increase in debt, while others saw a decrease in long-term debt maturities. The issuance of new bonds by PPL Electric and the unused capacity in the intercompany money pool agreement suggest that the company is managing its debt levels effectively. However, the depletion of PPL Electric's intercompany receivable balance indicates that the company may be relying more heavily on external financing sources. Overall, while there have been some changes in debt levels and interest expenses, the company appears to be navigating these changes effectively. The financial performance of various segments and regions within the company has been analyzed. Notably, the Kentucky regulated segment performed exceptionally well, generating substantial revenues from contracts. Similarly, the transmission revenue segment saw a steady increase in revenue as transmission services were provided and consumed over time. In the regulated segments, Pennsylvania and Rhode Island also showed promising results. The distribution revenue of both regions performed well, with Pennsylvania's transmission revenue also contributing positively to its overall performance. Additionally, Rhode Island's natural gas distribution revenue was a notable highlight. However, there were some areas of concern. The amortization segment in all three regulated regions, Kentucky, Pennsylvania, and Rhode Island, showed poor performance, with significant losses reported for 2023. This indicates that the company may need to reassess its amortization strategies to improve overall financial health. Management's outlook for the company is cautious due to various risks and uncertainties. The company faces challenges in complying with environmental regulations, which may require modifications or cessation of operations. However, recent EPA rule changes have reduced the likelihood of such outcomes. The company anticipates increased load demand driven by data centers and emerging technologies, necessitating significant capital expenditures to meet new demands. Management is focused on managing various risks, including regulatory risks, price risks, and pension liabilities. To mitigate these risks, the company has implemented strategies such as recovering costs from customers through regulated rates and utilizing interest rate derivatives to manage interest rate risk. Management expects operating revenues to increase due to factors such as higher energy prices, customer volumes, and increased transmission expenses recovery. The company is also focused on managing its financial position and results of operations, presenting them fairly in accordance with accounting principles. Overall, management's strategy is centered around adapting to changing market conditions and regulatory requirements while ensuring the company's long-term growth and liquidity. PPL Corporation's financial performance overview. The financial performance of PPL Corporation reveals a consistent trend in dividend payments. The company has a history of paying dividends, as evident from the numerous references to this fact throughout its reports. This indicates a commitment to returning value to shareholders through regular dividend distributions. In addition to dividend payments, PPL has also engaged in share buybacks. A notable instance of this is mentioned on page 171, highlighting the company's efforts to optimize shareholder value through strategic capital allocation decisions. There are valid concerns about inventory buildup and supply chain disruptions in the company's operations. On page 12, it is mentioned that fuel inventory levels must be maintained to avoid operational disruptions, but reliability can be affected by various factors. This suggests a delicate balance between inventory management and potential supply chain risks. Furthermore, pages 25 and 56 highlight the potential for supply chain disruptions or delays, which could have significant consequences on the company's operations. Additionally, page 28 notes that cybersecurity threats also pose a risk to the supply chains, emphasizing the need for robust security measures to mitigate these risks. The financial implications of these concerns are evident in pages 52 and 56, where it is reported that fuel purchases increased by $213 million in 2025 compared to 2024, primarily due to a $40 million increase in commodity costs. This highlights the potential for significant financial burdens on the company if supply chain disruptions or inventory buildup occur. Lastly, page 184 mentions increasing future obligations for power purchases from OVEC, with a significant jump in total payments after 2030. While not explicitly stating inventory buildup or supply chain disruption, this note suggests that the company's energy procurement strategy may be vulnerable to market fluctuations and potential disruptions. That concludes the financial summary for PPL Corporation. Feel free to comment below, and I will be happy to answer them when possible.